Hey everybody, Tom Berry here with Investor Loan Source. My topic for today is what we're seeing in the loan applications that come through to Investor Loan Source. So this is kind of some tips for those of you that are out there doing real estate deals. And today I'm going to talk more about commercial real estate deals than residential. So what we are seeing with commercial deals that are being sent into us is we're seeing people using 6 months ago, 8, 9, 12 months ago cap rates to value their properties. So case in point, somebody brought me a deal. It was a second lien position for the rehab money on an apartment complex, and which we're okay with that type of loan. We will do a second as long as it meets all the proper parameters for the rehab money. The first was a bank, and it was a really dirt cheap interest rate, and it was locked in for another 5 years. So we were very comfortable with the first lien position. The second would have been a $2 million second for the rehab money to do all the renovations on this. And we would be okay with that whole scenario until we got to what is this property going to be worth once the rehab is done, once all the rents are raised to the market level. And this particular group was using an exit cap rate of 5.5%. Now, you might argue and say, yeah, but Tom, I've seen some stuff sell at that. I've seen some stuff recently sell for 5.5. And you have. I have too. But here was the challenge. Can we reasonably expect that by the time we get this loan done, they get their funds, they get this large apartment complex completely rehabbed, then they market it, then they get the lease up done, then they get all the old leases turned around to the new lease rates? Guys, we're now talking at least a year and most likely 2 years out. And what's happening to cap rates today? In every single commercial asset class, they are doing this. Now, they're not doing this, but they're not doing this. They're at about a 50-degree angle on a bar chart going this way. So what we have to do is we have to look at a project at what it's going to be worth when you get it done, not what it would be worth if it were done today, because let's be honest, it's not done today. Today it's a busted up ugly property with low rents. So when you're looking at using an exit cap rate, make sure you're taking into consideration the trajectory of cap rates today. And with cap rates doing this, you need to be using a much higher exit cap than what that particular product is selling for at today's rates. For us, 2 years out, on a multifamily, there is no way we're going to allow a 5.5 cap be that exit cap. So I think we did a service to this group by not doing the loan, because I am hopeful that on their projected numbers, they don't do the deal, because it's not a good deal, in my opinion, for where we are. So hopefully that's helpful, and I will see you on the next video.